Number one rule of Wall Street. Nobody, I don't care if you're Warren Buffett or if you're Jimmy Buffett, nobody knows if the stock is going to go up, down, sideways, or in fucking circles. Least of all stockbrokers. Right? It's all a fugazi. You know what a fugazi is?
No, Fugazi. It's fake.
Yeah, fugazi. It's a wazi, it's a woozy, it's a fairy dust. It doesn't exist. It's never landed. It is no matter. It's not on the elemental chart. It's not fucking real.
Right.
All right? Right.
Hello, folks. Welcome back for another weekly market recap. It's Saturday morning once again. The week, at least from the economic calendar standpoint, was a bit dull because, of course, we had the government shutdown. And, it was quite curious and almost hilarious on my side to see people screaming, oh, the government is shut down, the market is going to crash. And I was like, why? I mean, why should it? Okay. The biggest impact it was that we didn't have the BLS releasing labor market data, which to some degree might actually have been a positive for the markets because, as I said throughout the week, if you can't release labor market data, well, we can't say the economy is going down the drain, therefore we should pump to Valhalla, right? Like bad news are cancelled, right? But seriously, should we address the situation with the shutdown now or later on? Well, let's do it now, right? So with that out of the way, we can go on to the rest. Now, look, this would be a recap of the shutdowns in the US getting back to 1976. And as you can see, right, Trump is on the record for the longest one because otherwise he wouldn't be Trump if he wasn't, the best and the biggest, right? Even in this competition, okay? And that was 2018. So it's not the first time the government has shut down. And look, there are two types of shutdown, all right? Now, what we are dealing now, I mean, the market, right, or, the world, especially in the US, but what we are dealing with now is a budget issue, right? So it's nothing crazy. The worst case scenario is that they are going to close down temporarily a few public parks or natural parks here and there. Nothing else is going to be that catastrophic. So don't worry, they will keep on paying the interest on the debt. The mandatory spending, so social security, healthcare, Medicare, and all the rest, it's going to be taken care of because it's already decided, it's already approved. And it's not like just because we have the shutdown, those flows are going to be suspended, right? You might say we need to close down temporarily a few public offices and structure, like again, the BLS, because we don't have the money to pay the workers. But, up until a point, I don't remember if it's a bit different now, but I do remember that when they come back to work, they are paid in full for the entire month, no matter how many days they actually stayed home. So if you want to argue for some damage, it's just another type of inefficiency, but it's not something which is catastrophic for the US as a country or, as a government. Also, for those which were already screaming, the market is going to crash because XYZ, the shutdown, yeah, but just sometimes it's so easy as looking at the numbers, all right? Look, stocks don't really care, right? So this is a list or a summary of the previous shutdowns with, the timing of them, the president which was in office throughout those days, and these are the S&P returns and the 12-month after type of returns. So as you can see, there is not a lot of red in this in this data set, and all the red you can see, it's basically in the 70s. And if you check what was happening to the 70s, it was the period of the great inflation, right, with rates skyrocketing, and we had like 2 or 3 recession all condensed in the same decade. So, it was kind of normal to have some years, right, where the market was down. And even if you check these huge concentration of red after 12 months, if not for 1976, all the rest it was positive at the end of it. So the shutdown fear, it's just another type of fear that the market just looked passed through it, and it said, yeah, doesn't matter, it's no big deal. We are going to keep on bidding, right? The infinite bidding, it's keep going. So don't worry about that, quite honestly. Now, let's have a look at those tiny things we had from the economic calendar standpoint. Now, we had the jolts on a Tuesday. I think I remember it was Tuesday. Yeah. Uh, Bad. I would say bad. Not only for the trend, not only for the fact that the number which came in was kind of in line, right? There wasn't a massive deviation there, but they revised the previous figures to the downside, I think. So again, there is not a lot of new jobs created in the U.S. economy. It's not, it's not incredibly bad yet, but still just a testimony of the fact that the economy is slowing down. It's not falling down off of a cliff, right? It's just slowing down, right? So don't freak out just yet. Give it another 6 months maybe, but don't freak out. Look, the quits rate again came down. We have been in this place before. We have been looking at this metric. It's just the amount of people which are willingly quitting the job. And of course, if the rate is going down, it's because people tend to hold on to their jobs because maybe they look around and now they don't think it would be as easy as it was in the past to find another job. I don't know, maybe your neighbor has just been fired, or maybe you have some relatives which have lost their jobs and they can't find another one, or maybe you wouldn't be able, or you think you wouldn't be able to find another one which would pay you as good as the current one you got, right? Then ADP came in because this is a private type of a report, so it's not reliant on the BLS, uh, and it was again down. So even this one, it's not that good. I think it was down how much? Minus 32, yeah. And the previous one, minus 3. I think this one was revised too, if I'm not mistaken. The previous one was revised down, if I'm not mistaken. We could check, but do I really want to check? Maybe. Let's see. Just because it's, yeah, as you can see, there is a revision here. So the previous was 7.181. But wait, so it was revised slightly to the upside? Hmm. It says revised from, and now you see 7.2. So, well, yeah, okay. Apparently that was revised to the upside, but again, the trend, it's, what is it? Yeah, there you go. It's not enticing, right? Let's have a look. Then we got the ISM manufacturing PMI, which came in still below 50, so still in contraction. Um, I mean, it's just stalling in here. It's not really going anywhere, but still, the fact that it's not going to the upside, it just shows you that, yeah, I mean, bring back manufacturing, but the manufacturing sector is actually not showing it. And even if you check the manufacturing employment, yeah, a little bit of an uptick over the last two reads. So basically starting in July, but the trend for the last 5 years is still to the downside. Um, there was, I think, even some services. Now, of course, considering how the U.S. economy is structured, uh, services tend to have a much bigger weight on the net overall result. Of course, it's more of a service economy rather than a manufacturing one. And even services, as you can see, they're trending down for now, and they're really close to the lows that we got in 2023 and 2024. So, not enticing. To to sum it up, it looks now at the end of the day, what we got is an economy which, for the first time, if you look at the orange line right here, it's creating less jobs than the amount of people which are currently unemployed, because of course the ratio it's below 1, right? So yeah, I mean it's not a good situation. But getting back to the manufacturing, right? Now you see that when manufacturing actually goes negative, or at least in contraction below 50, usually it's not a good time. Now of course, again, since the manufacturing it's what 32% of the overall economic output in the US, it's not always the case that when it goes in contraction, we actually have a recession. But if you look at a composite index, like for instance, it could be this one right here, which is weighted, of course. Now, 70 should be, of course, the part related to services, and 30 the part related to the manufacturing. It looks like we are just hovering around that recession or that red alert type of line in here. But as you can see, we dip below it, we come back up, dip below it, come back up. So again, is the economy overall, at least from this metric standpoint, is the economy on a very slippery path, or a very dangerous place? Well, yeah, it looks like it, but you know it's still not there. So there are cracks, there are risks, there are dangers, but overall, we are not at that breaking point for now. We'll see. Let's see how, at least let's see how 2025 closes down, and then we will try to reassess the whole when we got the final figures for the year 2025. But for now, I think the risk of a recession in the next 60, 90 days, for me personally, it's a bit on the lower side. Now, if we expand the forecast out from, let's say, 12 to 18 months, well, maybe at that point, would you go like 50-50? As for the odds, maybe even 55 slightly in favor of a recession actually coming. What it could be, but again, we need more data, we need more evidences, right? Um, as for the rest, the break evens, they kept on going down, so inflation risk, it's a bit tamed for now. Although we have a little bit of a discrepancy, even in trueflation, because you look at PCE, which came down like a lot since the middle of September, while instead CPI came up. Now it's still in this range, so still hovering around 2%, but it was just a nice discrepancy in my view. We'll see how it goes. Um, GDP now, of course, still giving you 3.8. Oh, and it wasn't updated because it was, supposedly it should have been updated on October the 1st, but then we got the shutdown. So yeah, even this one wasn't updated. Fed Watch, it's now giving you what? 96% possibility of a cut. What? Should this be? Wait, the current is what? That is the current. So 25 basis points, basically. Although throughout the week, I don't remember, but I should have a screenshot of that. For a brief moment, there was a 1% chance of a 50 basis points cut. So this column right here was actually, populated on the left, and we had the 1% in here. I'll see if I can retrieve the screenshot later on when I edit and publish the video. It lasted what, maybe 12 hours, and then Fed funds futures got back to quote unquote normality, but it was there nonetheless. All right. Credit spreads still particularly tight. Do you want to zoom in to see what happened? Yeah, still in this range. Nothing major for now in this one. So all in all, as you can see, not a lot from the economic calendar standpoint, if not those same and usual confirmations that maybe there is a little bit of a problem in the labor market, and therefore in the underpinnings of the US economy, right? So that would be it. Let's move on into the charts. As for the charts, let's start out with oil. Oh, just to shuffle things around a little bit. This week we start out with oil. which had a pretty bearish week. It was down throughout all the week. It started on Monday, and then all the rest, Tuesday, Wednesday, Friday, it was everything was down. Now look, we've been particularly bearish on oil, so we had this little bit of a consolidation, and it looks like finally we might have broken the support which was holding the entire structure. Where could we go now? I think there is a little bit of support around, call it 59, right? Um, so I don't think there is a lot like in between now and 59. It's just one point at the end of the day. But the way we actually came back down was kind of, again, it was classical in my view. Like you got a major swing, which is defining your dealing range, a swing failure pattern, and then down you go into the other direction. We have seen the same thing on Bitcoin, for instance, like what, 2, 3 weeks ago. So, I think again, the fundamentals are not supporting a bullish thesis for oil, at least in the very short term, as usual. And we might see what is going to happen in this region. Probably another bounce, I would say. If anything catastrophic comes out, I would say another bounce, most likely in here. How high? I don't know. Could be, I don't know. Could be something like this. We keep on going down. We bounce from here. We coming back into here. We stall a little bit, and then it will make up its mind, I guess. If I had to bet, I would say in time. Again, when you draw these squiggly lines, one thing is kind of trying to build up an expectation, right? Of what you do expect from price, or what type of behavior you expect to see. But just bear in mind that it won't almost never follow the exact timeline that you give it to it, right? So again, it could be another bounce. We stall a little bit and then could go up and testing back into this previous support, confirming it as resistance now, or it could just go in straight down. I don't know, but what I do know, the most pressing thing for me, the most immediate thing for me to observe would be to see how do we react at this level. All right, that would be the first major telltale sign for me, and then from there we see the reaction and we assess what was it. So for now, not a lot. Oil for me is always kind of one and the same. Bearish, mid to long term for now. Short term, it could ebb and flow around because it's very highly influenced by geopolitical events or news or, announcements of wars and all the rest. So who knows? But I don't I don't see any particular reason still for these assets to keep on being particularly resilient to the upside. So right, let's have a look at gold instead. Now gold, it kept on going higher even this week. So 3,900 and what? And 22 was the high of the week, and we didn't close that far from the high of the week. So that should tell you that we still have a strong trend. Um, we just eventually pull back in this region right here before moving higher again. Uh, it doesn't look like it so far. At least when I see strong closes on a Friday like these, I would expect continuation first and foremost. So again, do you want to play the game one more time? So maybe, I don't know, Monday, Tuesday could be a bit like this, right? And then we pull back maybe. And when you do expect a pullback, the question is always, okay, do we pull back into the previous weekly range, right? We hold it and then we keep on going to the upside, right? Kind of like this it could be. Or could we just break the previous weekly range, getting back to a much more, deep type of a base, or in this case it's a shelf, and then we start to reaccumulate from there and we push higher from there. It depends on how you assess the momentum, right? Now, for instance, by looking at these, I would say the eventuality of getting back into it period and then keep on going to the upside, to me is a bit more likely. Just because I would expect this asset to keep on behaving the way it was behaving before. Look at this 2-3 months consolidation, the breakout, and then you see the momentum is sustained. Just take the bearish candles, for instance, as a measurement or as a reference point. Check this one out. Um, as you can see, was never retested, right? Then you check this other one, this cluster here. This was retested and we went up dramatically. So again, then this one, the following one, this here, this cluster right here, was never retested. We just kept on going higher. So this one, I mean, we didn't retest 1 and 2, just the one in the middle. So yeah, it could be that we form another high, we come back into this one, and we keep on going. Still, just because the momentum for now it's so strong, it's hard to break a momentum, right? Uh, it takes some sort of a news, some sort of an event. If you don't have that catalyst, which is usually exogenous, it's beyond simple market forces, it's hard for me to see the momentum actually shifting. So up until the point we keep on behaving like this, and especially up until the point we can't break back below 3,750, I would say the momentum is still strong to the upside, and we should expect higher price for oil. Sorry, for gold. So yeah, that would be it for me. Now let's have a look at some currencies. The currency market didn't move a lot, so the exotic or the BRICS currencies, they the yuan pulled back a bit after the drop the previous week. Indian rupee still particularly weak, as you can see. All right. And then what we got, the Brazilian real still maintaining that relative strength compared to the rest. Same with this one up in this middle and upper quadrant, South African rand. Russian ruble had a little bit of a pullback this week, but I keep on looking at it, and it still looks like a rounded redistribution for me. So up until the point it can get back above. Let's pick a line in the sand. This level right here, right up until the point it kind of gets back above it, retests it, maintaining above it. I wouldn't be so bullish. As for the Australian dollar, um, well, I mean, for now, it's very choppy, but it's grinding to the upside, at least for now, right? Let's have a look at the majors. So we have seen the DXY kind of exhausting that momentum to the upside. We drifted back in the previous bulk of liquidity, so previous that should be the middle point of this overall range we are dealing in for right now. So conversely, the euro came back up. It found resistance at a previous level, which should have been anticipated support, and it was broken. As you can see, tiny bounce, broken, and now we're finding resistance into it. So nothing new, even in here. Same for the pound, same type of behavior of the euro with a bit more of a volatility, and considering the SMT, a bit more weakness maybe. The Japanese yen tried, there was this attempt to the downside here. It was quickly rejected, and we bounced back into the range we have been since the beginning of August. So, I mean, there is not a lot of volatility overall, or at least, there is not a clear direction for currencies in the very short term. If you zoom out, you're still looking at overall a weaker DXY and foreign currencies, a bit more to the stronger side. One might be better than the other. For instance, the Canadian dollar, it looks like one of the weakest in this segment right here, while instead the Swiss franc is still the strongest of the pack you know in this pack right here. it was just a week which was a pretty dull for currencies, so don't waste a lot of time on it. Now the dollar, it's the dollar, it's still it's just a DXY, right? Um, it's not conclusive yet, but I'm still on the high watch for something brewing in the dollar. Now, look, for instance, let's have a look at these. There is a good correlation in between the DXY and the so-called surprise index, right? Now, as we see right now, there is a little bit of a divergence. The surprise index went up. The dollar stayed relatively stable. So if you check the past, what you see is that when the red line goes up, sooner or later, the dollars actually follow. When the red line, let's call it, distributes and crashes down, the dollars kind of do the same with a little bit of a lag, right? That there is a distribution and then it follows. Same here, right? The dollar was relatively stable. The red line started to go down and the dollar eventually followed. Then, of course, in anticipation, the red line reversed and, with a little bit of a lag, the dollar actually did the same. And then, same thing going on, right? The red line puts in a double top and then it goes down. The dollar puts in some sort of a, with a little bit of a fantasy, you could call it a head and shoulder, maybe, but then eventually it goes down. So could this be that now that the surprise index is moving to the upside or move to the upside? I don't think this is up to date, but with a just in principle, could it be that you see a bit of strength or strengthening dynamic into the dollar relative to the other currencies? It could be, I think it could be. I'm not sure on the timing, but if you remember, I've been on that type of watch for a potential surprise into the dollar for a month and some at this point. And the simple fact that it didn't go lower from here, it could be a telltale sign that we are really trying to put in around the reaccumulation. When this idea goes completely out of the window, again, when we break the previous lows, and instead of having a swing failure pattern right in here, we actually have a close and continuation below them, right? At that point, I might say, yeah, well, that was absolutely wrong. The market proved that wrong, so there is no need to keep on arguing for it. Why would why would you say the dollar is relevant? I mean, at the end of the day, well, it's because of these, right? If you check the correlation in between the dollar and other risk on assets, you see that it's negative. So a stronger dollar would put pressure on other risk on assets. Um, all of them are impacted in different ways, so that there is not the same type of correlations for everyone. But you can see, for instance, that the most influenced it's gold, right? Gold miners, silver, and then Bitcoin. While instead something like Ethereum, it doesn't have a lot of a correlation with the dollar. Of course, the different columns and the different colors, it's just a reference to the last 20 days, 50 days, and from January to the beginning of the year 2025 to this date. Incidentally enough, when you check something like the S&P, especially from the beginning of the year, it doesn't seem to have a very strong or inverse correlation with the dollar. And it's much more evident if you check something like this. So for instance, you see that overall, by the way, the dollar in this case is the dotted red line in the background, and you have the S&P in black, right? So if you check, it's true that when the dollar was actually skyrocketing, the S&P was at least flat, if not pulling back a little bit, like in here, for instance, or as you can see in 2022. So in here, right, we had a little bit of a correction which lasted 6, 7, 8 months in 2022. So from the beginning of the year up until October, the end of October. So yeah, almost 10 months, right? And even in the past, when the dollar was going up, like in this case, in the of course 2008, right? you might go like, yeah, no shit, Sherlock, but still. Overall, though, if you zoom out enough, right, and if you check, for instance, 2008, where was the dollar? Was in here, right? Where was the S&P? Was in here in 2009. And if you go forward in 2025, where is the DXY? It's in here. So it went from, let's say, 74, 72 up to currently 90, what, 98, 97, 98, right? Okay. Where was the S&P? Well, in 2008, 2009, it was, you can't even see the number, probably 600. I think there was the devil. There was the devil involved. I think it was what, 666, right? and and then now he's at what? Almost 10 times that. So again, there is not a huge negative correlation in my view, because when you got money pouring into the US and being deployed into US assets, what you need to do first in order to acquire US assets? Well, those are priced in dollars. So first, you need the dollars. So over a long period of time, if the rest of the world is still moving capital flows into the US to acquire your, I don't know, your Teslas, your Nvidias, your Microsofts, your Googles, your Apples, and all the rest, right? The first thing you need to do in order to be exposed to those markets, it's acquiring the dollars which are needed to buy up those assets. Which is why, again, if you smooth things out, those two assets should go up together. Now, there might be a lot of volatility in between, which, and again, the correlation at the end of it, it's still negative, all right? Although we are talking about very short-term correlation, right? Now, here we are looking at a much bigger period, right? We are looking at it in terms of months and years, not intra-year, right? I think it just makes sense at the end of it. Um, you might say that, in the short term, a stronger dollar is bad for the S&P. Well, why? Well, because if the dollar goes up, those companies in the US which are selling their products or their services abroad, they suffer a little bit of a slowdown, because for foreigners now, it's a bit more expensive to buy American stuff if the dollar is going up, right, relative to their currency. So you might see a contraction in foreign demand. And don't forget that when you check out the composition of the S&P companies' revenues, 40% of that comes from foreigners. So it's just normal that in the mid to short term, a stronger dollar, it might impact negatively revenues and therefore earnings for those companies which are actually selling US products and services to foreigners. But overall, you see that they tend to move up and down together. That's the way I would rationalize the entire thing, right? Now let's move on from the dollar. Let's have a look at yields. So yields, they came back down a tiny bit, not majorly, but again, if you remember, this was kind of the area where I was expecting a bit of a pullback. It came kind of in it 4.2. I was expecting a little bit of a sideways action into it, and quite honestly, I think it wouldn't be surprising to see now yields getting back up again, stalling a little bit, and then finally breaking for new lows for the year, right? But it was just, it just came shy of the level a little bit, didn't have the pause, and immediately dropped. We'll see. We'll see. It could very, you know, I'm open to the possibility that that was it, and we are gonna see lower yields. I don't, the reason why I'm not completely trusting that scenario of a sharp pullback and immediately down It's because we have too many things, right, going around, which could, from one week to the next impact the views or the short-term expectations of inflation and therefore the behavior of yields. So I think it wouldn't be unusual to see another push to the upside before maybe seeing overall yields getting back down, which, it should lead to another low into the futures as for the treasuries, which could be bought up after all, right? Now, uh, there's not a lot to say about the futures. It's basically the inverse of what yields are doing overall. You might wonder why I do have a fib on it on the 10-year. Well, it was that one showing this gap while the other two they weren't. So I said, you know what? I'm gonna measure. It was a very crude, but it was a very raw type of approximation on my side, which was very discretionary. So don't do it. But I took basically the upper side of the range before the gap and the lower side of the range based on candle closes instead of the weeks. And I said, let me check where price did top back into before bouncing to the upside. And, was kind of precise at the end of it. Right. So can we get back down into it again? Yeah, absolutely. But again, I think overall, in time, with lower yields, you should see these assets keep on slowly grinding to the upside, right? For you know, for a little while longer. I'm not saying we are going to have another bull market in treasuries or in American bonds as what we've seen, let's say, for the past 34 years, but a macro bounce, if you wish, it could be it could be on the cards for me, right? Now let's move on to Bitcoin because Bitcoin was crazy, I think. Now, not crazy just for the price excursion and this massive leg up that we had, but it was another one of those things where you can be wrong overall on your bias or your expectations, right? But at the same time, you could have profited massively from this move to the upside. I'm gonna show you a screenshot. This is from last week recap, all right? Now, first, let's have a look at what Bitcoin did. First and foremost, right? Let's zoom in. So the premise might have been, it looks particularly weak, right? And I don't know how much resting liquidity it could be to hold up this entire price action. So it looks heavy. It might be that this time around we are not going to be able to hold this region again and we might drop below it. And at that point, I was saying, it wouldn't be incredible to see it coming back below 105. Okay, but the other case, so the opposite scenario, because you always need to have two, right? And you always need to have invalidation points for this, for the one you deem as most probable, right? So the counter to all of these, it was look, but let's take the screenshot, right? But if we found buyers into this region, and we can first of all getting back to test this structure right here on the daily, right? Previous support, bounce. So this line right here, if we can test it, you might have a little bit of a pause there, but then price will eventually keep on pushing, and we are gonna get above the previous important, uh, you know, the resistance first, support later on, flip the resistance. So if we can reclaim it and maybe pushing through, then coming back into it, you know, and put together a move to the upside. Again, in the context that you don't have to check the dates. So the timeline of it's quite irrelevant. It's just to give the squiggly lines enough room to be visible. Because if you just draw it like all tied up together, you're not going to see shit on TradingView. This is the thing, right? So the point was about the invalidation points, the potential responses and behaviors that we could have seen at different levels, and the eventual final destination, right? Now it just turns out that what you see is basically that. Like, look, we get back into this region right here, and what you see? That's a very brief pause, right? If you go back on the 4 hour. See? Pause, tiny consolidation, we move up. We move up, we break through that level we were talking about, right? Resistance, resistance, support, failed support, confirm that's resistance, now flipped, down we go. Now if we reclaim that, let's get ready because we might test back into it. And if you check the 4 hours, we actually did. We tested back into it, another tiny pause, and up we go. So again, that was it. And even at this previous wing failure pattern level, look, we might have a tiny little pause, and then again up we go, right? Did we have that? Well, not a lot. I mean, you could say that maybe if you really zoom in, right, while we were testing it, we might have had a little bit of a rejection on first pass, but it was very short-lived. So all in all, although it wasn't quite perfect, although the timing of it wasn't really the same, but as you can see, the dynamics are always the same, right? And at the end of the day, when your bias, when your bearish structure, when your bearish case is invalidated, it doesn't take you a lot to be positioned in these sort of moves. And again, did you have to be long at the actual lows, right? No. But it was once again a matter of having the best price available or having the best confirmation possible. So again, the more risk reward you want, the more you have to sacrifice on information and therefore confirmation. While the more odds you want to have in your favor, then you have to sacrifice a little bit on your risk reward, but you kind of gain a bit more clarity, a bit more confirmation. Therefore, the odds are dramatically shifting in your favor. So whether you were entering at this junction right here, or as I would have done, most likely, waiting for the reclaim of this level, the test back into it, and the confirmation we closed above, at that point, you know what? I'm in now, right? Which would have been essentially this one. Get above it, test back into it. At this point, when you see it coming back through, what you might say is, all right, so then I don't want to see price action getting back below this low. I actually want to see these peak up to the downside being respected. So I'm going to enter in this dealing range right here, wherever I can find a decent entry, right? And I'm going to exit the market if we push back below it, or, just peak up right here, okay? Now, usually on these sort of trades, you want to see a reaction sooner rather than later. And look, these fractal behavior, it works on Bitcoin 4 hours as it works on the NASDAQ if you check at a 15 seconds chart, right? And quite honestly, this is one of my favorite entry drill, right? Waiting for the market to push into a level, right? Getting back above it and developing this type of structure, reclaiming the previous dealing range, hovering for a little bit, and then starting to go up. I'm never gonna be long in here, right? But I'm gonna be long in here somewhere with my stop below the previous dealing range, which was now reclaimed, right? Will it work every single time? Absolutely not, right? The thing I love about these type of behavior is that when it works right away. So not only you have your risk already defined, right, from a structural standpoint, and then of course you adjust your sizes and you decide what type of a percentage risk you want to put on the trade, but you also have some sort of a time component into it, right? So let's say in this case, it was a 4 hour type of setup. So you might say, look, I'm pretty confident in this one, and I'm gonna start to reevaluate things, reassess things if I don't see it actually going in the next what could be in the next 12, 16 hours. So over the next 4 candles, 3 or 4 candles, I want to see it going, right? And it, you know, since the nature of price action is fractal, you could expand the entire thing on a 1 minute chart. You find the same type of behavior, and then you can say, I want to have that tiny little stop right there. If this thing is not going over the next 7, 8, 9 minutes, I'm going to drastically tighten my stop or exiting the trade right away. So it gives you a lot of information. It gives you a lot of things you can rely upon to manage your risk, to keep your risk tight, and to assess how your expectations are actually being respected or not by the market. So you want to see price action delivering what you wait for sooner rather than later when you're looking at these type of setups. All right. I didn't have any clue when I started recording that we would have discussed entry drills, but yeah, that was it, I guess. Now, we're gonna check the stock market now, but before that, as usual, let me just put some things in order. So now let's have a look at the heat map first and foremost. Now, as you can see, it was kind of a good week for the equity market. But yeah, there is again a little bit of a mixed bag result if you check the different sectors. And at the end of the day, the market was up because the leading sector was up, like Nvidia, like Apple, Microsoft. Now Meta was slightly down, but again, even in here, right? You see AMD is up, RTX is up. So you could say XLK as a sector was up, and that's really what is driving the index up overall, right? It's it could be clear even if you check this one right here, right? So as you can see, healthcare. Wow, healthcare. Didn't notice that healthcare was up almost 7%. Oh, I got it. Yeah, I think it was because it was some sort of a regulatory type of thing. They, I think the regulator actually approved companies like I think it was Eli Lilly to bring their drug to the market, or approving some steps of the process to get that drug onto the market. And I think they actually discussed some tariffs exemption if they can actually deliver it. So again, the market was on fire. At least the sector was on fire just for that. Um, yeah, it was not only not only Eli Lilly, but I think AbbVie was up and a few others. Not all of them, of course, but yeah, overall the sector was up. So uh, you know, even in this type of a graphic right here, you can see that although the index was up, right? Because of course it will go up if technology is up. Now technology is like what, 33, 34% of the index. So yeah, um, utilities were up just because of course, that there is this AI race right now, which is still in play, and utilities is a good chunk of it. Um, Industrial was kind of up, slightly up, but you know, financials, after being up for a good chunk of the previous month, they finally gave back a tiny bit, so they were down slightly. Energy was down because what we've seen in the oil market, for instance, and I think a few companies like maybe I'm gonna make a name, but I'm not sure is that one. But companies like ExxonMobil, right? They actually came in with lays off now because look, if the price of the barrel is going down so much, I can't keep up my margins if I don't cut a bit of jobs, right? Communications were down, and consumer discretionary was down, but overall, as you can see, where the technology goes, the rest of the index follows. Now, before looking at the technicals, there might be something interesting. I'm not going to dive a lot into it. You might want to check that out on your own. But you see that there is all these teams. It started out like 10 days ago, I think, with Nvidia, announcing to invest 100 billions into OpenAI. All right, for the data center bleed out. Hmm. How will OpenAI build out the network, the infrastructure? Well, that's great. They're gonna buy up what? Nvidia's chips. So, look, everyone wants to build AI. Everyone needs the Nvidia's chips. Now, what can Nvidia do? Nvidia can take a part of those revenues to invest in those companies which are developing, the software, right? So that they can buy more Nvidia hardware, boosting Nvidia revenues farther up. So some folks actually raise the question, isn't it just, profits recycling? And it's not just Nvidia and AI, but then we have seen Nvidia buying up a good chunk of Intel, and then other companies, they announced partnership with other companies uh, on the same tune of this one, like I invest that amount on you, and you commit to buy these services, these hardware from me. So it's just I think, in the very short term, it will most certainly contribute to keep those, profits up, and therefore those earnings keep on growing. Over the long run, I think it's not such an healthy sign, in my view. The circular type of at a point, it's an accounting gimmick, all right? So I don't, I think it's going to end badly at a point. Because look, how sometimes I think, getting back to the theme of the everything bubble and all the rest, sometimes I think, how much are these guys spending? They're talking about billions, right, and trillions to commit to the AI build up, all right? But what's going to be the return, all right? Because if you think that the return will be just selling out a subscription for $20 a month to people like me, which are going to be able to use AI, which is now used mainly as a search engine. Like, instead of going on to Google, which gives you all the possible results and the related type of contents, now with AI, what you do is just you ask the thing, and the prompt is going to give you back right what you were looking for, way more specific as for the answer. So, I mean, I I see the huge investments. I have to see yet the potential profits coming in for these guys. Now, sure, I'm not saying AI is going to be the future, right? That's for sure. It's probably boost productivity in other sectors as well. But all I'm saying is, yeah, many other different companies could benefit from AI, cutting costs, increasing productivity, and all the rest. But considering the amount of money these guys are pouring in, what I mean, where is the return, or when it's going to be the return? All right. So at a point, I think, yeah, the market will need to face that these high evaluations are not made up by profits, returns, and growing revenues, and therefore earnings. And when you have some earnings revisions, that's when we might call for the bubble to potentially starting to pop. But up until that point, what we got is still a narrative which is untouched. Fundamentally, these companies are still making money, no matter what you think or what I think about these potential profits recycling and whatnot. So what we are left with is the technicals. And the technicals are telling you that this market is still strong. So zooming in, what you see, and this week was, I mean, was really cool. Look, Monday, right? Really goes nowhere. Goes up overnight, comes back down, all right? Then in New York, it pumps to the upside again. And then what you have, it's basically, we are already in Tuesday at this point, so Monday, Tuesday, right? Then what we got on Wednesday, a huge drop, all right? and below the weekly open and below the Monday's lows, right? And then straight up on Wednesday, right? Thursday we have a little bit of a pullback. Friday we keep on pumping, and we end up the week with some a bit of selling, right? What was interesting to me, it was how the weekly, the at the end of the day, the weekly candle was designed and it was shaped up. Monday, Tuesday, accumulation. So dealing range from here down to here, right? A little bit of a weaker Nasdaq initially with a lower high instead of a higher high like in the S&P, but still overall the result was the same at the end of the day. Massive push to the downside on Wednesday. So depends on what school you have grown up as an analyst or as a trader, but someone might call it accumulation, manipulation, expansion and redistribution. All right. Or it could just be, dealing range. So liquidity going particularly thick in this region. We have a pickup of liquidity lower because we couldn't break to the upside after these. So we needed to push down lower seeking buyers. We found buyers and up we go at this point. So the market just needed to fill up the tank with liquidity on the buy side, and then we could jump. Actually, I mean, Wednesday was crazy. We just zoomed to the upside, right? Then, of course, the daily time frame, it tells you that at this point, we made a new high, right? New all-time highs, right? Both for Nasdaq, S&P, the the Dow Jones. I think don't have a lot on this chart right here, but did we hit new all-time highs? Because you don't have another these two. This is just December future. Let's see. Let's have a look at the continuing. Yeah, yeah. Was new all-time highs for the Dow as well. Yeah. And the Russell. I No, I don't think the Russell was new all-time high. Absolutely not yet. Nowhere near. Yeah. Okay. So the important thing is that we keep on pushing highs. Therefore, it's really hard to be bearish these markets. Now, we left last week saying, wouldn't be surprised at all if we see new all-time highs this week. And then remember the last part of the week. And then maybe, just maybe, if we see the market pushing up, but the RSI is not following through, the stochastic it's not pointing decisively to the upside, and we generate even a divergence on the MACD histogram, at this point we might be on the high watch for a potential deeper pullback in October, right? Now, you might have a divergence present at the current moment in time. On the Nasdaq, you might say it is already confirmed. If you want to be aggressive, but we traded below the previous daily low and we closed right around it. So you might say this divergence it's confirmed now. On the S&P, not so much, but it is also true that I'm used to see the Nasdaq leading. So I mean, if the Nasdaq comes down, I would expect the S&P to come down with it. I'm not saying it's going to come down. I'm just saying, we just made a new high, new all-time high. So don't be overly bearish. I'm just saying another tiny drop next week to maintaining to keep up the theme of a grinding market where you have a expansion to the upside and then a slow grinding back down, a drawing back before the next extension to the upside. Yeah, could be. Overall, let's have a look at these from a higher time frame perspective. If you check the monthly time frame, right? Sure, bullish, of course, but another thing, we are now looking at what 1, 2, 3, 4, 5 months of basically just advances, right? At a point, we are going to need to have a little bit of a pullback on a monthly base. So, be ready because it might come. And quite honestly, if it would come in October, it would, to me, it would be the best scenario. You have a little bit of a drop in October overall. You you take the chance of buying the dip, and you ride the uptrend into the year end, right? If if you want to also put in a little bit of seasonality, just because if you check the past, right? How many green candles on a monthly base can you count before the market finally takes a break, right? One, two, three, four, five, come down. One, two, three, four, five, comes down. One, two, down a bit. One, two, three, down a bit. So, uh, unless, if you discount 2022, where we had a massive, well, massive, but let's say just a true correction instead of a dip. But, even prior to it, what we got is one, two, three, down, one, two, three, yeah, down for almost a year. Prior to it, let's go back to the 2020, so the COVID lows. Whether you believe it or not, on a monthly time scale, you remember where what was the narrative? How are you feeling back then? It's the end of the world as we know it. If 5 years, if you look back at it now, it's just a blip on the radar, and it was a massive buying opportunity. After that, one, two, three, four, five, down. So again, considering that on a monthly base, we just had 5 monthly advances, although again, I'm not bearish overall, but a tiny bit of a correction, wouldn't be unusual in my view. And probably I would assess it at the current moment in time as a buying the deep opportunity. The seasonality for the equity market sees October as a good enough month, right? So, it's not bad. But again, it's just statistics, right? Considering that we have seen August and September being particularly good, as I said, do we do things differently this year, right? Turns out that August and September might end up being green. Maybe you got an October which could be red, right? Who knows, right? But I think at the end of the day, just keep on focusing on the short-term price action in order to assess what it could be next week. So far, again, a little bit of a drop, maybe tiny bit, but overall, to me, it's always the same. Up until the point we don't break lows, we maintain above moving averages. This market, it's just going up. Just so don't try to short it, right? Now, and look, this is this is just numbers, right? You're just looking at numbers. Uh, 10% corrections, they happen 13% of the times, right? And when you look at a correction from 10 to 20%, that happens 7% of the times. The majority of the time, the market is going up. So, you know, look, you might say that especially after '08 and all the distortion, QE, the massive inflation of the monetary base and the central banks pumping in money whenever they see the market just attempting to break lower, you might say that we are living in an era, in an age of excessive returns, right? Maybe, but these are just the numbers, and this is what we have to work with up until the point they are proven wrong. So, always betting on this time is different. We're going to have another 50% crash. This is another Great Depression 2.0. This is another financial crisis. This is another .com. It's going to come at a point, but I think you're going to know the market will give you all the clues you need before we get there. In the fundamentals, as for earnings, revenues, uh, earnings growth projections, and all the rest, um, you will see stress in the credit market, right? You will see these markets starting to crack moving averages and then using them as a resistance instead of a support. So, Again, we get back to the old theme. You don't need to catch the top. You don't need to be short the top or sell everything at the top. Same as you don't need to buy everything at the bottom. Just follow what the market is doing. And for now, the market is continuously telling you that this is not a market you do want to sell on a larger time frame, right? Then intraday, intraweek, there are many different shorts you can take. Uh, Actually, shorts, I do like to short the market, but not because it's not that I think the market is going to go down, but sometimes even intraday is so overextended that taking those shorts it's just sweet because they play out so fast. It's a matter of minutes, or more often than not, and you can get from 30 to 50 points in less than 5, 7, 8 minutes, which is it's kind of cool. While instead taking the long, although it statistically pays you more, but especially intraday, if you want to maintain a tight enough type of stop loss, you need to be patient. All right, if you want to if you want to ride those wings to the upside intra-week or intraday, which is why again, it's always a matter of perspective. And you can be a massive bull overall on a macro standpoint and still being a very good short seller intraday, right? Now, let's briefly check the economic calendar for next week. What we got? I think if we keep on seeing the U.S. government being shut down, probably not a lot. But on paper, at least for now, we should have a lot of fat zombies talking, and nothing more than that. So cool. So even if there is a shutdown, it's not going to impact a lot. Maybe we are not going to have the jobless claims on a Thursday if the government is still closed. And hmm, are we going to have the Michigan consumer sentiment? Hmm. Because it's the University of Michigan, right, releasing this data. Do they close down university as well if there is a shutdown? Hmm. I don't know. Actually, I don't know, so we'll see. But I mean, you're gonna know if you just check the news intra-week. So with that, I think there's not a lot more to discuss. And actually, I want to go and enjoy the weekend at this point, considering we are having a good weather outside. I'm gonna leave you off with that. I'm gonna wish you a very good rest of your weekend. And as usual, be nice and be cool. We talk again next week. News out.
Mm-hmm. Mm-hmm. Mm-hmm.